2026, for some of you, this will be the best year you've ever had. For some of you, this will be a year that you wish you could forget. Guys, every single year, I get called from the major networks to come out and talk about my top stocks for the year, what I see the opportunity, where I see the risk. I've turned them all down for this episode. Why? Because 2026 is like no year we've ever seen. For those of you who are prepared, this will be the single greatest opportunity you've ever seen in your life as an entrepreneur, as an investor. You do not even understand the risk that is coming in this economy, the debt that's coming, the loss of jobs that are coming. There are a lot of things that will be happening that people are not prepared for. So in this episode, it's not going to be just fun and games about what 2 or 3 stocks to pick, but I'm going to tell you more importantly, how do you protect yourself from being unemployed, from losing your home, from your business shutting down, how to prepare the next generation, your kids, to make sure that they have a future that's as good or better than yours. That is how serious this episode is. I'm going to tell you what are the things you need to avoid and what are the things that are going to present the biggest opportunity that you've seen ever coming in 2026. Welcome to the American Capitalist Show 2026. Let me tell you right now, for some of you guys, this is going to be the biggest economic opportunity you've seen and potentially could see in your lifetime. I'm super optimistic for a lot of you guys out there, but for the other people out there, I think this is going to be very close to what we saw in 2008, 2009. I believe people are going to be hitting the unemployment line in record numbers. I think businesses are going to be closing. You're going to see foreclosures happening. And all of this is preventable if you know what to do. So in today's episode of The American Capitalist, what I want to do is break down these risks so you're prepared. But I also want to give you where the opportunities are going to be. So if you're somebody who believes that you're responsible for your own future, if you're somebody who believes that, yes, in a capitalistic society, there's going to be winners or losers, but you're willing to win, this is the episode of the year that you want to see going into 2026. If you're preparing a business, if you're entering the job market, if you're someone who's getting ready to retire in the next few years, wherever you're at right now, there's going to be some unprecedented things that are going on that you're going to have an action plan for. And that action plan today, let me tell you, it looks way different than it did 20 years ago, 10 years ago. And the truth is, there's some things that are happening out there right now that are causing the speed of change to be faster than it's ever been before. And the problem is, I think most Americans are nowhere near as prepared as they need to be able to handle this. And I'm also going to talk about the opportunities that are out there. And I do believe there are some opportunities. Why I'm not as optimistic, though, as I normally am, is I think most people today are not prepared for those opportunities. And I also think most people are not aware of how bad the risks really are. Why? Probably because of design. Whether it's the right or left, no one really wants to scare anybody. There's a lot of things that are going out there. We just came off of an election that they weren't going to tell you everything was going to be crashing, that unemployment was going to be skyrocketing, that foreclosures were going to be picking up. But I'm going to give you the data today so you can see for yourself why I'm worried. But also, worry is not a strategy. Panic is not a strategy. Hope is not a strategy. So let's get into some of the tactics that you can use to prevent yourself from becoming a victim, but also to be opportunistic to be able to capitalize on the opportunity that we're seeing today. Okay, let's first get into the risks that I'm seeing here. There's 2 major risks that I'm going to talk about today. Before I get into debt, and I think debt's the number one problem that we've got facing this country and the economy over the coming year or 2 years, I want to talk about the direction of interest rates because everybody's worried or wondering what's going to be happening with interest rates. When Trump got into office, we all know that he was pressuring the Fed to bring interest rates down. Why was he doing that? I'm going to talk a little bit about the commercial debt real estate problem that we have, and I think that's exactly why he was doing that. But overall, I think we've seen some interest rate cuts. We've got the 30-year mortgage down to around 6.25%, 6.3%. But I personally do not believe that interest rates are going to go down much more from where we're at right now unless we see a huge economic hardship. And so, like they say, you want to be careful what you wish for, because if we do get significantly lower interest rates, you know what that means. It means home prices are lower. It means unemployment is going up. It means people are in a really, really bad situation. And that's technically when the Fed usually comes in to raise interest rates. And I know a lot of you guys don't really even understand this dynamic of interest rates. Why is it important? Who's in control of it? Well, the Fed, and they've been having these meetings, they recently cut interest rates. They control short-term interest rates of what's going to be happening with the economy. Then the rest of the free market decides where mortgage rates go, where commercial real estate rates go, where corporate real estate rates go. That's basically supply and demand. But in general, what you need to know is that interest rates are the single most important economic indicator of what's going to be happening. Meaning, if I just knew one piece of data over the next year, 2, 3 years, they said, Rob, I can only give you one piece of economic data. What would it be for you to make business decisions out of, investment decisions out of? I would say it's going to be interest rates. And why? Interest rates, when you think about the Fed, their job is two things. Number one, keep inflation under control. Number two, make sure that people have jobs, right? So they don't want inflation too high, because whatever you're earning isn't going to make any difference because you won't be able to afford things. And they don't want people without jobs because in the U.S., we are a consumer-driven economy. Without people having jobs, we don't expand. Okay, but in order to do those two things, they only have one tool, and that tool is interest rates. So they're doing two of the biggest things out there for our economy. Keep inflation in check, make sure people have jobs with one tool, interest rates. That's how important interest rates are for those of you guys who didn't get it. And why? Let me just give you a really simple example. And we'll talk about this in a minute in terms of all the credit card debt that's out there right now. If you've got credit card debt, okay, and your credit card interest rates are 22 or 23%, and you've got, let's say, 10 grand in credit card debt every single month, let's just say your debt payment is $600 to those credit cards. Well, when that paycheck comes in, if $600 in interest goes out to that credit card company, what does that mean to you? Well, it means that's not going into your education. It's not being paid to buy new clothes. You're not buying food. You're not traveling with it. It's just going to interest on stuff you already bought a long time ago to Citibank or Chase or any of those people. Okay. Now, what happens if that interest rate went to 40%? Well, instead of $600, it would be $1,200 that you'd be paying every single month. And what would that do to your own personal balance sheet? How would your life be if all of a sudden your credit card payments doubled without you buying anything new, just the crap that you bought a long time ago that you're paying for? Well, it probably would hurt. You'd be able to spend even less on clothes or toys for your kids or going out and shopping or any of those things. Now, let's look at the inverse of that. What if those interest rates drop down to 1%? And instead of paying $600 or $1,200 on the credit card, you're only paying $100 a month. Well, all of a sudden, that frees up an extra $500 a month that you can go out and buy goods and services and all these things. And so what that does is the lower the interest rates are, the more free cash flow that puts back into your pocket. It puts back into the pocket of corporations. So that means you're spending more. Businesses are spending more. They're hiring, not firing or laying off because they have higher debt service. So lower interest rates are what fuel the economy. Higher interest rates, the corollary, when you see inflation skyrocketing, what does the Fed do? What were they doing for a long period of time? Well, they raise interest rates, so they try to slow down the economy. And when you're paying more to the credit card company or businesses are, what does that mean? There's less money that's going to the economy. So what does that mean for prices? They have to come down because people can't afford things unless the price is cheaper. So therein lies how they get inflation down. So interest rates are the single most important thing that you need to know. When the Fed wants the economy to grow, they lower interest rates. When they want it to slow down, they raise interest rates. So that's why it's so important. Now, the Fed tells us at every meeting what they predict is going to happen over the next 12 months. So they're telling us right now that they're only going to, in 2026, cut rates 25 basis points more, which essentially, guys, that's already priced into everything you're paying on student loans, credit card loans, mortgage rates. It's not going to really move the needle, only 25 basis points. Now, the question is the Fed lying? Are they bluffing? Well, I don't think they're bluffing, but I also don't think they understand the magnitude of how bad I think this economy is going to get. And as I just told you a second ago, the problem is if we're going to get a lot lower interest rates, which we all want, because like I just told you, if you've got less money that's going to your credit card debt. If mortgage rates all of a sudden go from 6% to 3%, more people could afford homes. All those things are great if they come down, but if you don't have a job, it doesn't matter if interest rates are 3 or 2 or 1 or 0% because you can't afford any mortgage payment, and that's the problem. The only way that interest rates get significantly lower from now, and the Fed's already telling you this, if we start to see the economy crash. So be careful what you wish for on interest rates. I think some of the major risks that we're seeing as a country, in businesses, in real estate, all have to do with the amount of debt that we have right now. We're running at about $36 trillion right now. And the problem with that is most of the debt that the US has is long-term debt. So if we've seen interest rates skyrocket, what's happened is just the debt service, what the government has to pay every year on that debt, is exceeding $1 trillion. And I know for a lot of people, that's hard to put in perspective, but the amount of debt payments that we need to make each year just on the interest, that exceeds what we spend on the entire defense budget to protect the citizens of this country. So it's becoming an increasingly large problem. And why do you even worry about the country being in debt? Can't they just print more money? All of those things. Well, yes, that's true. However, it's just like with a consumer. Yes, a credit card company, a bank will lend you money, but there's going to be a limit to it. And they're going to say at some point, Mr. Jones, Mrs. Jones, you need to pay some of that debt off, or we're going to give you significantly higher rates. And the problem is we don't own all our debt. Countries like China own our debt. Europe owns our debt. There is levered players out there who own our debt. And so what happens is the more debt that we continue to rack up, and let alone you could have credit agencies downgrade us, the higher those payments are going to have to be. And so you cannot continue to run a deficit without paying back your bills before someone comes to the table and say, it's time to pay up. So we know as a country, at some point in time, we're going to have to swallow a hard pill. We're going to have to take our medicine. We're going to have to start putting in a plan that actually pays this back. And a lot of people thought, okay, Republicans, Trump's in, we're going to start really making a dent on this. Well, what I could tell you is, based off of today's budget, we are actually adding nearly $2 trillion to that debt every single year. So that debt number is going up. It's not going down. So you have to think about the long term. How do you take care of this? What are the things in Congress? What do we have to do to make sure we can start putting this country back on better footing? And maybe not for you and I, but I know I have, a daughter who's about to go to college. I've got a 2-year-old son. I am worried about their future, because the opportunities that I've had, that many of you had, have happened because we had a solid balance sheet. We were growing GDP larger than we were growing debt. That has not happened for a long period of time. Our debt to GDP ratio is over 120%, which means even if we grew 7 to 8% and we only grow at 2, it would take over a decade just to get to even. So it's not happening without a few things. What are those couple of things that we need to do? Well, number one, we have to start looking at things like entitlements, Social Security. We already know most Americans today, more than ever, are relying on Social Security. The problem is Social Security is near bankrupt. So what does that mean? We're going to have to make some hard changes. And maybe some of those things are like means testing. So if you're making more than $50,000 a year, maybe you don't get Social Security. Are people prepared for that today? I don't think so. Pension funds are gone. Most people are not taking care of their 401k. We're at a point in society where people cannot afford for Social Security to be minimized or taken away from them. But what's really the number one thing that I think is inevitable? It's going to happen based off of what this administration is able to do in the next 3 years. We'll see. It's taxes. Taxes are going to have to increase. And taxes, whether you're a corporation or you're an individual, what does that mean? It means less money in businesses' pockets, less they could hire, less money in your pocket, and more money back to the government, not to provide jobs, not to create opportunity, but just to pay the debt that we have right now. And so long term, our country is in a lot of trouble. Long term, if you look out into the future, I do not believe we will ever in this country see tax rates lower than we have today. And we're already upset with how much we're paying for taxes. So the future in terms of the debt, at some point in time, we're going to have to take care of this. But let's put the government aside for a second. What about you? What about the average household? What about the average individual? How does their balance sheet look? It looks horrible. It's the worst I've ever seen in my career. How so? Well, credit card debt. Credit cards, guys, after an emergency fund, meaning putting away 3 months to 6 months of living expenses, what I tell everybody, make sure that you get your credit card debt to zero. Why? Credit card interest rates in this country right now are about 23%. There is no investment out there that's going to give you a guaranteed rate of return of 23%. Not the stock market, not the real estate market. So every dollar you pay back to Chase or Bank of America or Citibank or whoever it is that has your credit card debt, you're giving yourself a guaranteed rate of return or 22, 23, some of you 24%. And the problem is right now in this country, we're at the highest levels we've ever seen in credit card debt. And I think what's happening is, especially with the younger generation, instead of foregoing that trip or foregoing that new jacket or whatever it is, they're just buying those things still, again, not taking the hard medicine by putting that on credit cards. And what happens with credit card debt? It consumes you. It allows you, it keeps you on your mom's couch. It doesn't allow you to go out there and buy a home. And eventually you're going to be so strapped on credit card debt that you're not going to be able to participate in this economy, something that I'm really worried about. Well, what about auto loans? Well, we're seeing auto loan delinquencies, meaning people are not paying back their auto loans now, the highest that we've seen since 2009. Do you remember 2009? It was the worst economic time since the Great Depression. Why aren't people talking more about this? And oh, by the way, have you seen you can get 72-month, 80-month loans now on an auto loan? I remember when I first got my first truck payment, I think 4 years, 48 months was the max. We're continuing to push that out. So what are we doing? We're giving people more opportunity to take on more debt. We're saddling them and putting them into a position where they will never, ever be able to get out of this. And we're hearing things now like a 50-year mortgage. A 50-year mortgage, guys, is probably the single worst idea I've ever heard for home affordability ever. What is that going to do? It's going to do the same thing we've done with credit cards. It's going to do the same thing that we've done with home loans. And I, for one, am sick and tired of supporting the bill for all these horrible ideas. Do you remember what we did with 2006, 2007 that caused the housing crisis? Well, Nancy Pelosi, Barney Frank, all the Democrats in their infinite wisdom said, hey, I think everybody should own a home. Let's make homes available to everybody. So what did they do? They created liar loans, right? Where you didn't even have to show your W-2s. You didn't have to show your tax returns. All you had to do was say, I made $1 million and they would give you a home loan. Well, how did that end? It ended with the worst housing crash since we ever saw in this country. Home prices plummeted 40%, 50%. Because people had no skin in the game, they had no money in down payments, they lied about the loans, they just walked away. So the people who paid their bills, they put 20, 30% down payments like I did, like many of you did on their homes. What happened to us? We continued to make the payments and we saw our values decline 20, 30%. Remember PPP loans during COVID? How about that scam? We saw people that were getting money for their businesses, hundreds of thousands of dollars that they were spending on exotic cars. Don't believe me? Take a look at the news of some of the people that are going to jail for some of those loans. I know our company was offered and qualified for nearly $1 million in PPP loans. We didn't take them. Why? Because we believe in the long-term opportunities of this country. We believe in the American dream. And the more we do things like PPP loans, and the more we do things like liar loans, and the more we do things like 50-year mortgages, the more we kick the can down the road of having to step up and actually make something of ourselves and make this country great again. And also what we do is we open the door and we reward mediocrity, which is something we do time and time again. And we think about American exceptionalism. Debt is the number one thing I believe that is holding us back. And a lot of people say, well, hey, 50-year mortgage, good idea. People can buy a home, the payment's less. The payment's not that much less. My team and I did some research on this. When you take a look at the 50-year mortgage, guys, take a look at a $500,000 home. In a lot of neighborhoods, you could still buy a really nice home for $500,000. You put your regular down payment at a 6% interest rate. That payment is somewhere around $3,000 a month. Okay, what happens if we extend that out? Okay, if we extend that out to 50 years, the payment only drops from $3,000 to about $2,650 or $2,700 a month. So you save only $300. What do you get for that $300? Well, let me tell you, on the 30-year mortgage, a $500,000 home over 30 years, because of the interest, you pay about $1 million. On the 50-year mortgage, over 50 years, a $500,000, you pay $1.5 million. So a $500,000 more to save $300. And oh, by the way, most people are buying their home at 30, early 30s. So by the time you retire, by design, a 30-year mortgage, retire at 62, 65, your biggest expense that you have as a consumer is paid off. So now you're in retirement. You don't have that payment anymore. You could put that towards healthcare, towards food, towards travel. Well, what about the 50-year mortgage? When you retire, you're still going to have another 20 years left, unless people are going to start retiring at 82, 83. This is a moral hazard, guys. This is not taking our medicine. And this is being offered by Republicans. So it doesn't matter what side of the aisle you're on. They are continuing to build this economy, to fuel this economy through debt. And I'm here to tell you that it's not sustainable. So that's the government. That's individuals that are debt laden. What about corporations, guys? Well, 40% of maturities of over $13 trillion in debt needs to be refinanced in the next 24 months. These are businesses that employ people, that keep the economy going. Those rates that they have to roll over, that they have to refinance, because they're not taking on debt at 30 years. When you're a business, you're taking on debt that's at 5 years, and you either have to pay it back in 5 years or you have to refinance it. When they took this debt out 5 years ago, they're paying 2 to 4%. Today, that same debt is 7 to 9%. So what does that mean? They're not making any more money, but the money that comes into the business, more of it now has to go, just like the government, just like you at your house, with higher credit card rates, higher bond interest rates. More of the company's money has to start going back to paying debt. And what does that mean? If they can't do that, they start to lay off people. They start to spend less on different goods. And what does that do? It slows down the economy. What about real estate? Commercial real estate debt, we are coming up against, over the next 2 years, $3 trillion in commercial real estate debt that needs to be refinanced. This is the largest amount that we've ever had to refinance. And just like the credit card debt, just like the corporate debt that I told you about, when they took this debt out before, 3 to 4%, today 7 to 9%. So here's the problem with commercial real estate that I think a lot of you are not aware of, that you need to know about. And again, when we thought about housing market in 2007, 2008, a lot of people said, hey, I'm not invested in real estate. Doesn't matter to me. It probably mattered, though, when we saw unemployment skyrocket, when people were afraid if there was going to even be in their money in bank. We saw over 1,000 banks shut down. Why? Because all the people that held those mortgages and how that infiltrated everything. Well, commercial real estate, do you realize how many big institutions and banks own these loans that are probably not going to be paid back, that are not going to be able to be refinanced? Well, why? Well, I just told you the payments are going to go up significantly. And the problem is, if you look post-COVID, people are not taking on as much office space anymore. We're seeing in most major markets 20 to 30% delinquency. That's up significantly where we saw pre-COVID. And these are businesses that are not going back to taking on these huge amount of spaces. So now you've got buildings where you have less rental income that's coming in, so less money coming in to pay the bills, but the bills are about to go up because the interest service on this debt is about to rise. I continue to go on and pile on debt, but I'm telling you guys, debt is what got us into some of the biggest problems we've ever seen in this country's history, including almost a 70% stock market decline, 60% real estate market decline in 2007 and 2008. So if you're just going to sit here and say that this is not an issue, this is not a big problem, you could have said the same thing in 06 and 07, and you would have seen your portfolio significantly wiped out. While I'm not saying it's going to be a repeat of 2007 and 2008, if you are not paying attention to this, if you're one of the people that are over-levered, whether you're a business, whether you're an individual with credit card debt, what happens if you lose your job? What happens if you get a pay cut? Those payments are not going away. As a matter of fact, the payments are probably going higher, and you are not prepared. So debt, by far, is the number one risk to this economy that we have in 26 and probably 27, to be honest with you. Okay, the second biggest risk for you in the economy in 2026, artificial intelligence, AI. The number one problem that I talked about, the number one worry that I talked about for this country, for the consumer, for the housing market, for the commercial real estate market is debt. And hopefully now you understand why interest rates are so important. And hopefully you understand the magnitude of what we just talked about, of all this national deficit, credit card debt, auto delinquencies. Because if you understand that, and we've set the stage for what could be a very challenging economy, I'm going to get into what I believe is the second biggest risk to the economy that, yeah, people are talking about it. But just like interest rates, I think a lot of people hear interest rates are rising, but they don't really get what that means. And now I think you get what that means. When they rise, your credit card debt goes up, you can't afford homes, that crashes the economy, right? And so artificial intelligence, let's kind of simplify this and let's take an approach of what does it mean to you? What does it mean if you have a business? What does it mean for your kids? How should you be approaching AI from the standpoint of, are you really in trouble? Is this just, something that everyone's talking about and it's really not going to impact you? Okay. So I think most of you know this is not my full-time job. We own a wealth management firm, we own a tax firm, and where I spend most of my time is working with mid-sized businesses between about $5 million and $100 million in revenue. So mid to small-sized businesses who, by the way, are the largest employer in America. And so this is literally the finger on the pulse of what's happening to the economy. And I talk to these people on a daily basis. I consult with them. They ask me to come in and help them build their businesses, sell their businesses, and most importantly, increase the cash flow of their businesses. Because at the end of the day, if you have a business, you do that to make more money. And so I can tell you, having been doing this for a long period of time right now, we're busier than we've ever been before. And what are the calls coming about? They're coming about two things. Number one, artificial intelligence. What does that mean to my business? How do I implement it? And what are the changes that I need to make to this business? And so while these are business owners that are calling me, this is all of you. A lot of you are business owners, but if you're not, you probably work for one of them. So you want to listen and pay attention to behind the scenes. What are these conversations? So all of the work that I'm doing today is based on productivity. What does that mean? How do they get more out of their business by spending less? And a stat that I've seen in general about productivity out there in the headlines is companies are increasing productivity anywhere from about 20 to 40%. Based off of the work that I'm doing, I think that makes sense, somewhere around 30 to 40%. Now, the problem with productivity, it's a double-edged sword. And productivity just means how efficient are you, right? For every dollar you make, how fast do you make it? How little does it cost you to make it? So you want to make more money in less time and have that dollar that you make cost you less. Meaning, if you earn $1 in revenue, you'd rather have your input cost be 10 cents than 90 cents. You'd rather earn 90 cents on that dollar than 10 cents on that dollar. And the more productivity that you can get, the better off your business. So the problem with productivity, though, is it does allow businesses to become more profitable. So again, if they can build a widget with one person instead of four, that's less labor costs that they're going to have. If they can get it done in 1 day instead of 10 days, that's more that they can get to the market and more that they can sell. And so that's what all these businesses are trying to do right now. And artificial intelligence is doing a few things for this. So what people are saying is, hey, Rob, how do we do more with less? So what we call it is flat organizations. How do you build a small team that's able to operate as efficiently as maybe, let's call it a 100-person team was before? How do you do that with 10 people? The scary thing is it's a lot easier than you might think. And let me tell you what we do. And so a lot of you, and this is for those of you, again, who are working for people, and I call you intrapreneurs. And those of you who own business, I call you entrepreneurs, because the one skill set that you will have to have with AI coming is to be an entrepreneur. And what I mean by that is everybody that I talk to today, when I come in, I talk to their businesses, they want people who can run the organization. They want people that can run their department. They want people that can pivot from thing to thing. They don't know. They want people who are flexible. They want people who can keep up with the speed and demand of what AI is bringing to the market. And the speed at which things change today, the speed at which you need to operate today are exponentially faster than they were 10 years ago, 5 years ago, or even a year ago. And so when I talk to the people today, we have something that we talk about as a 3-tiered approach. We want to first build a small team of all-stars. And that's the tough thing, these guys today. It's hard to find really good people. So you're looking to find only the best of the best, which means you're not hiring second-tier players. You're not hiring third-tier players. You are only hiring the best, most qualified, experienced people who can come in right away and execute. So you want a small team of all-stars. Number 2, you want all-star processes, meaning when they come in, they're not trying to figure shit out. You've got processes of here's how we bring on clients. Here's how we service clients. Here's how we execute. Here's how we get greater share of wallet. There are processes that you have that are defined and ready to go for these all-stars to come in. And then third, what I tell everybody is you need to have all-star technology. And this today is where AI is playing a bigger role than ever before. And so let's think about that. If you've got a small team of all-stars, I already told you, how do you go from 100 people to 10? You get 10 really good people. You empower them with AI. And if those of you who've used things like Gemini, ChatGPT, take a look at your own productivity. And I could tell you from myself, as a use case example, I have probably, not 40%, I have probably become 80 to 90% more efficient in what I'm doing today. And so what I do, though, is I take 25 plus years of experience in tax, estate planning, managing assets, and building businesses. I don't come with zero. I bring that to the table, and then I am using artificial intelligence to expedite that, clean it up, make it faster, make it more powerful. And what I could tell you is proposals that I would do, analysis that I would do, due diligence that would take me literally 2 to 3 days, I am getting done in 2 to 3 hours. Not only am I getting it done in the 2 to 3 hours, it's better, it's faster, and because of the client that has this expectations, I am meeting higher expectations. So what I am doing is telling them, okay, who's your small team of all-stars? We take a look at who those players are. Who are your next tier middle manager players? And what do you think happens to the next tier middle manager players? Today, you just read the headlines. Look at Facebook, look at Oracle, look at Tesla. Everybody is firing middle management. Middle management will not, and these are white collar jobs, guys. Middle management will not exist 3 to 4 years from now. You will have that team of all-stars managing a team of all-star processes. All those people in the next 2 to 3 years will be fired and on the unemployment line. I don't know where they're going, because they're not at the highest level, they're not at the lowest level, they're there in the middle, they're in a lot of trouble. The next thing, when I talk about all-star technology, this is where a lot of blue-collar, entry-level, you already hear about college graduates not being able to find jobs. Why? Because they're not all-stars. They don't have experience. They don't have knowledge and execution. And today, what we're doing with the lower level or entry level is we're either taking the technology to build the upper level so we don't need them, we're wiping out the middle level, and we are automating processes and tasks through artificial intelligence. I'm not going to name, there's software program after software program, whether you're in media, whether you're in construction, whether you're in finance like we are able to use automated algorithms and artificial intelligence to literally wipe out what we used to call in financial services as power planners. That they'd have to get with you and find out, what's important to you, where do you live, take the pulse of how much debt do you have, how much this do you have. We don't need them anymore. There's an algorithm we run, you answer a couple questions, and we get that more detailed, efficient, and easier than you before. So those people have been wiped out. Now, when you start thinking about that, where does that transcend to? You're seeing it happening in robotics, in healthcare. Take a look at what's going on with Tesla and Optimus of what they're doing with robots on the assembly line. It's crazy how efficient they are. More than likely, the vast majority of assembly lines will now be working through robotics. So they're not going to have individuals out there plugging in the lug nuts. Why? Because there's robots can do it. And what about robots, guys? Well, they work 24 hours, 7 days a week. They don't need breaks. They don't need health care. They don't complain. They just show up. And with artificial intelligence, they're actually more efficient, smarter, faster, and obviously cheaper than individuals are. So those jobs are going to be going away also. And I'm just telling you, these are things that I've seen in 12 to 24 months. So when you start thinking that you've got a 5-year or 10-year time horizon that you're going to have before these things happen, you are mistaken. It's not going to happen. So the headlines of people laying off, the people that do not have jobs, the people that do not have intrinsic skill sets that they can then magnify through artificial intelligence, because artificial intelligence isn't taking jobs. It's high-level people who are using artificial intelligence to take the jobs from average people, and that trend will continue. So, one of the things I talked about in terms of the biggest risks out here are also the biggest opportunities. We just talked about debt. So if everybody has debt and they're forced to sell their businesses, they're forced to sell their real estate at a cheap price, well, what does that mean if you've got cash? Well, when we talk about artificial intelligence and we say, hey, the people that are there to sleep at the wheel, that don't really have any skill set, that are just there 9 to 5, they're just showing up and doing a job, no matter what that job is, artificial intelligence is going to be able to take it away from them. Those are people that are going to be displaced. But what about the people who are great executors? What about the people that are able to go into an organization and make an immediate impact and use artificial intelligence to take the job to 3 to 4 people? Those people will start to be making more. And I could tell you this already, guys. It's not that I go into these businesses and we say, hey, let's just make you more profitable. Let's get some cheap, shitty, quick service out to your clients through artificial intelligence, and let's get rid of all the middle management. No. What we're saying is, how do we deliver better service to clients? How do we take those high-level all-star people who might have only been able to serve 10 to 15 clients or customers before and serve 100 at a higher level? Well, what we do is we equip them with artificial intelligence. But remember, I told you it's pretty hard to get good people, not only to keep them, but to train them and get them to stay. You pay them a lot more money. So at every organization, I'm working on 4 different consulting projects right now. We are firing people greater than I've ever seen before. We're buying technology, and we are taking all that money that we're getting, and we're increasing salaries by 20, 40. I have some cases doubling the salaries of these all-star people. And still at the end of the day, we've got a team of all-stars that's way better paid now. We've got efficient processes and technology that's delivering better service to our clients. And we've got some change left over to put that in the bank to make these businesses more profitable. Now, the show's called American Capitalist, guys. If you don't think that capitalism is about doing more with less, if you don't think it's about putting better products out for less, if you think this is about altruism and you think businesses are there to be nonprofit organizations and do what's nice, I think you're going to be sadly mistaken. So I'm just giving you the insight of all the artificial intelligence you hear about, talking about there not being a worry that you don't have to worry about. I'll tell you, start worrying, because it's not coming, it's already here. There's layoff slips. There's going to be some that are delivered, I know, at the beginning of the year to people that are coming, more coming, and it's coming faster than you might think. So you have to think in this equation, how are you going to be positioned? What is your skill set? Because if you're just an assembly line worker or if you're just a middle manager, I think the future looks really bleak. Now that I depressed all you guys about the debt and the fact you're going to lose your job to a robot, let's talk about some of the opportunities. Let's talk about how this economy could actually soar, more importantly, how you could soar. And the truth is, and I kind of alluded to this in the last segment, is the debt, if you have a good balance sheet, if you have cash on hand, you're going to be able to benefit from that. There's going to be a lot of forced sellers, so you're going to have some opportunity there. And the same risk of artificial intelligence I talked a little bit about, if you are ready for that, you're going to be able to take advantage of that opportunity as well. So let's talk about some of the specifics and where I see some of the biggest opportunities coming from. Well, if you're a real estate investor, I do believe that commercial real estate is going to be one of the biggest opportunities out there. Now, what I'll say, though, is it's going to take some time for this to play out. Don't say Rob said go buy commercial real estate and January 1st you're putting an offer letter in. Just wait some time, but have some dry powder. The good thing today, because interest rates are a little bit higher, your dry powder means a money market account that's earning about 3.5%. 5 years ago, that was 0. So you're actually getting paid to have what I call optionality, meaning you got money in the money market account. If something happens, you could deploy that into a good opportunity. I do believe there are going to be forced sellers of commercial real estate. And what is commercial real estate? It's a broad term. It's self-storage. It's multifamily housing, better known as apartments. It's industrial warehouse space, it's office space. All those things fall under the area of commercial real estate. What I would say is The area I'm probably least optimistic about is the Class A, especially office buildings, those big high-rise office buildings. Why? Because like I told you, a lot of the businesses are not coming back in the numbers that they did before. Industrial warehouse space, probably the best out there. Why? Because you're seeing everything go online. You're seeing all these data centers being built. So that is an area that I think will do really well. Now, when you start thinking about this, well, Rob, I understand why office space will probably get beat up. I understand, like maybe even multifamily housing, because we had a lot of building. A lot of people got in there, especially in multifamily housing, way over levered. They went in there and they took out loans and they were just thinking that they were going to have huge appreciation, which hasn't happened. I think multifamily housing, especially in areas like Miami, you know who you are. I think a lot of you are going to be in trouble coming here in the next year to 2 years. So why would like industrial warehouse space get beat up though? Because the economics around it, the fundamentals around it are pretty good. Well, just like I told you guys earlier in the show, in 2008, and I was one of the guys, in 2006, I actually had my previous wealth management firm in Scottsdale, Arizona. I was telling everybody, all of our clients that had rental real estate, and if you were in Arizona during 2006, even the waiters had rental real estate. Everybody had rental real estate. I was telling them it's time to sell your rental real estate. Why? Just because it made zero fundamental sense. I knew it was going to crash, just didn't know when it was going to happen. And it took about a year and a half for me to be proven right. And when I was proven right, we saw real estate prices drop almost 70% in Arizona during that period of time. But I was pretty young then. I wasn't as smart. I didn't have as much gray hair as I do now. I've seen a lot of things since then. The one thing I missed during that period of time is I didn't realize how bad the contagion would be. And like I told you, because of the fact that housing subprime, it wasn't just Chase Bank or ABC Bank that owned those loans. They were collateralized, which means that one loan was broken down into 100 parts, and those 100 parts were sold to mom and pop, banks, investors. So everybody got to participate in that contagion during that period of time. And so when the housing market crashed during 08 or 09, everybody was impacted. And why this is the single most important lesson that I learned in 2008 and that you should know and understand right now is that liquidity crises are the worst thing that could happen to stock market, real estate market, the economy. They happen fast and they are severe, they are deep, they are Great Depression types of things that happen. And why was 2008, 2009 a liquidity crisis versus something like the dot-com bust? Everyone heard about that. Whether you're old enough, you probably heard of the dot-com stocks in 2000 that crashed. It took the NASDAQ over a decade to get back to even. The difference there was that was a fundamental overvaluation. Stocks were just way too high, way too expensive. It was an absolute bubble, and that made sense. However, the stock market in 08, 09 really wasn't that expensive. The credit markets really weren't that bad. But here's what happens when you have a liquidity crisis. When there is a liquidity crisis and people don't have access to cash because banks shut down, they make sure you have a 900 credit score and $1 million in the bank before they'll lend to you. They cut your credit cards. If you guys remember 08 or 09, maybe you had $10,000 that Chase was letting you borrow. Then you got a notice that it got taken down to 1,000. Oh crap. Now I don't have a job and I don't even have credit cards to get me through. Remember those times? That's a liquidity crisis. And that happens to banks. It happens to individuals. And when there is a liquidity crisis, if you had a mortgage payment, guys, that's $3,000 and you've got $50 in the bank, what do? That's a crisis, right? A liquidity crisis. You need money. You got to pay $3,000. You've got $50. You need $2,950. What do you sell? You sell whatever you can. Your mother's earrings, your dad's watch that he gave you, your baseball card collection. You sell whatever people are willing to buy to pay the bills. And that's exactly what happens in a liquidity crisis. So if you wonder, like, why, Rob, are you talking about all this debt and telling us about the national debt? I'm telling you because my biggest concern about that is the fact that it could present a liquidity crisis where people can't refinance buildings. Their credit lines get cut. Businesses, small businesses in this world, guys, in this U.S. economy, which I told you are the #1 employer, are heavily rely on access to credit lines, especially new businesses that are starting up. They don't just fund it out of their back pocket, they borrow. And when you can't borrow, or if you have borrowing lines, and we saw this happen in 08 or 09, and they get cut in half and you're depending on that money to pay your employees, what happens? And so what I am worried about more than anything is a liquidity crisis. So that liquidity crisis is going to create huge opportunity in commercial real estate. So now going back to that, which is one of the big opportunities, yeah, maybe self-storage looks great. Maybe industrial warehouse space looks great. Maybe some of these data center deals look great, but you know what? They're sitting on fundamentally very shaky ground. And when people need to sell assets to pay for the crap assets that are tanking, they're going to sell whatever it is they can sell. And you know what the first thing it normally is? Is the single best assets. Why? Because that's all anyone wants to buy. Like if I'm sitting on cash and I'm telling you to sit on cash, when the shit hits the fan, what are we going to do? Go and buy the Miami over-levered apartment complex that's down 5 or 10%? Or are we going to wait until they need to start selling their good industrial warehouse space, which we all know that's in a shortage and there's huge demand? I'm going to wait for those good assets and I'm going to buy their winning assets. Same thing with the stock market. It's called the baby gets thrown out with the bathwater. You probably heard that, right? When you need to sell stocks to meet your crappy stocks that you're over levered on, what do? The stocks that were the winners, the stocks that are up. So what you start to see happening in a liquidity crisis is all the good stuff starts to get sold first because the bad stuff's burning down. So if you're looking for opportunity into 2026, it's by having a good balance sheet. It's by having access to capital. It's by having money in the bank, in money market, in good assets, and being ready to deploy. And I always think you should have some dry powder ready to take advantage of opportunities. But I think over the next year, 2026, probably more than ever that you're going to want to do that. So that's going to be one of the things. Real estate. But I think also, as much as I believe in the stock market long term, I do not believe 2026 is going to be a year that goes straight up. And we've already seen that in 2025. Where not all stocks participated. As a matter of fact, some of the smaller, less known, I know in my own portfolio, stocks that did exponentially better. I've got stocks up 200-300%, stocks you've never heard of. But some of the big names did not do as well. Why? Because these are the names that are going to be the biggest impact. When you're thinking about the stock market, let's talk about stocks. What type of stocks do you want to be buying in a market like this? Do you want to buy the stocks that are over levered? Do you want to buy the stocks that are in danger of becoming the next blockbuster because they were made extinct by Netflix, Radio Shack? Are these the companies that you want to be? Or do you want to buy the disruptors, the innovators? Do you want to buy the companies, because there's companies doing this also, guys, that have great balance sheets, to start picking up some of these companies that are over levered and because of a liquidity crisis will not be able to fund payroll. And now they're selling for pennies on the dollars. So in general, when you're looking at stocks, you want to look at stocks with very, very strong balance sheets. Stop being in the stuff that is over levered junk, because those are businesses that could be put out of business. And we talked about artificial intelligence being one of the biggest risks. It's also the biggest opportunity. When I talk about these stocks that we're making this money on, these are the artificial intelligence types of companies. And so when you're thinking about types of companies with great balance sheets, but companies that are increasing productivity, right? Because I already talked to you. When I go in and consult with businesses, what I do, I'm firing people, putting in great processes, rewarding the all-stars, and I'm finding all-star technology. What does all-star technology mean? It means we need to make investments in technology, whether it's robotics, software as a service that's enabled by AI. I am telling all these businesses, fire the crappy people, make big investments in AI. Some of those AI companies, a lot of them are publicly traded. So those are the companies that you want to start looking at. There's great people out there that are in that space, like Cathie Wood. She's got the ARK ETF you could take a look at. But start taking a look at some of the individual companies that are doing it out there. There is a lot of companies out there that are playing in this space. And if you are a company right now that makes companies more profitable, allows them to downsize, those are businesses that are going to do well. Think about cybersecurity. Okay, cybersecurity, we already know artificial intelligence is putting more things into the cloud. More companies are becoming reliant on artificial intelligence and computers and quantum computing and all these things. Okay, do you think your customers' data needs to be safe? Do you think by putting all this information into the cloud, putting all your processes into the cloud, as a company being reliant more and more on technology, does that make you more susceptible or less susceptible to hacks, to risks, to your customers' data being exposed? Obviously more. And so cybersecurity, companies like Palo Alto Networks and Zscaler and CrowdStrike, these are not recommendations, but these are publicly traded companies in that space who are continuing to take more market share, who are continuing to grow, who are continuing to increase the top line. Because think about it. I already told you, like, we might be heading to a recession, 50% chance, okay? As a business, when companies need to cut because the economy slows down, they have less money coming in, do you think they'll cut mediocre people, they'll cut maybe their travel budget? How many of those CEOs are going to get on a publicly traded quarterly conference call and say, hey guys, we decided we're going to cut our cybersecurity budget by 50%. CrowdStrike, we're getting rid of you. We just figured at this point in time, it's just the economy's bad. We could just make all of our clients' data susceptible to being hacked. Probably not going to work that way, guys. So you have to start thinking about, as an investor, right? A lot of people are always like, Rob, you're a business consultant and you're a stock market expert. It's the same thing, guys. Stocks, the stock market are just businesses that give you access to buy them publicly. But the way you look at small businesses are the same you look at big businesses. Maybe big businesses have more leverage and scalability, but this is a business issue and problem. So today, whether it's a private business or a publicly traded business, I am asking the questions. What does your balance sheet look like? What is your strategy for AI disruption? How are you protecting yourself? How are you helping other businesses, customers get better by implementing AI into your own space? Because if they do not have a plan for that, I walk away. So stock market, take a look at some of these companies in AI. Now think about the government also. The one thing about the government, we already talked, they've got a 38 trillion, they love spending money, but they are going to be forced at some point, I think sooner than later, to start cutting that spending. So when you think about defense, for example, or we've already heard Trump talking about, hey, it's a huge risk, and I believe this. We saw the supply chain issues at the beginning of this year because of tariffs. It's a huge risk that we're relying on China to build our ships, and it's a huge risk that we don't want to send humans out to the front line if we're dealing in countries like Russia, Ukraine, and those issues that we might be getting ourselves more into. So you start thinking about defense spending. Well, if we don't have to send troops out there and we become more efficient through the use of artificial technology, look at private companies like Anduril. Look at publicly traded companies like Palantir. Why are these companies doing well? Exactly what I'm telling you. They're making companies, the government, more profitable, more efficient, and better. Those are the companies that you want to buy. HII, Huntington, these guys are the largest shipbuilder in the U.S. Well, just start thinking about that. If HII is the only company that's building ships in the U.S., again, not a recommendation, but Trump's saying we want to put more money into being shipbuilding back into the U.S., do you think that's all going to go to people with an idea, or you think it's going to go to the incumbents who already have an opportunity out there? If you look at stock chart of HII, that's why it's starting to take off right now. So start looking at defense, start looking at artificial intelligence, start looking at companies that are going to be able to benefit from this. That is going to be a huge winner in the stock market, but I think there's going to be some dogs out there also that are going to become the next blockbuster. The next opportunity, and I think one of the biggest opportunities out there, I already told you guys, you need to become entrepreneurs. That's just the way it are, because whether you're going to work for somebody or you're going to work for yourself, you need to be an entrepreneur. When you work for somebody else, I call an entrepreneur. Everybody I'm hiring, including us these days, we want somebody who could stand alone and be an entrepreneur on their own. Small businesses. I love small businesses. Why? Well, you can buy them way cheaper than you can publicly traded businesses. Again, when I say stocks Small businesses are stocks. You just can't buy them in your Charles Schwab or E-Trade account. You have to go directly to that landscaping company or that HVAC company or that small bank or that media company or wherever it is, and you have a retail company, and you have to negotiate a private deal with them. But because it is private, because it's not as easy as clicking a button, what you will see is the multiple of those businesses is a lot less than publicly traded businesses. And what does that even mean? It means they're cheaper. It means for every dollar that a publicly traded company earns like Amazon or Microsoft or Nike, that stock trades anywhere from about 15 to 20 bucks. Okay, so it makes $1 in earnings. You have to pay $15 to $20 to buy that stock. Okay, you will see times, guys, small private companies, very profitable, more than the companies I just mentioned, you higher profit margins, sometimes trade 2 to 3 times. So for that dollar, you're paying $2 to $3 instead of 15 to 20. Wouldn't you rather do that? Why aren't you doing that? Education, knowledge. It's a lot easier to click a button on your keyboard and buy at Schwab than it is to put a term sheet together, than it is to put a business plan together, than it is to get financing, get investors, run a strategy. Therein lies the big difference of what's going to be happening in 26, 27, 30, 40, 50. You're going to have the people who do and are able to succeed and invest in themselves and are able to take advantage of these small businesses. Oh, by the way, 50% of small businesses right now today in the US, which I told you, the biggest employer, over 55 years of age. So they're aging out, which means they just want to get out of their business. And they're even willing to do seller financing. I've seen ridiculous deals where you don't even need bank money. They just want someone who's competent, has a business plan, and they believe can take this over, and they'll allow you to take it over because they know you can run it. You could actually pay them with their own money over time. Maybe that's an opportunity. But this is what's going to happen, guys who understand exactly what I'm saying, and they're understanding and learning these things and putting them in a position to capitalize on them. And people are just, it's like nails on the chalkboard when I talk. They just want to show up at 9 to 5. They just want to show up and collect their check, and they think that's going to be good enough. You can think it's going to be good enough until it's not. And see, the problem with this society is when you start looking at the opportunities, I believe, of today or tomorrow, it's not the political sound bites anymore. It's not the why do politicians spend so much money on 30-second ads? Because you want to vote that way. Because you don't want to be a critical thinker, because you don't want to put in the work. You don't want to learn. You just want to show up. And it's worked for a long period of time. It worked for your grandparents. It worked for a lot of our parents. Remember, you didn't even need to go to college. You got out of high school. You got a job on the assembly line at Ford. You retired at 60, and Ford paid you $5,000 a month for the rest of your life. Oh, and you got Social Security on top of it. It was a pension fund. Okay. How many companies are giving out pension funds these days? Goose egg. Oh, maybe if you want to become an NYPD cop, you'll get a pension fund. Good luck with that. Hopefully you survive that. But there's no pension funds anymore, which means there's only 401ks. And people don't even understand the value of their 401k because they're too lazy to understand that. So they're not putting money into their 401k, which means when this artificial intelligence boom comes and those people are out of work, they're going to have to tap their 401k until that's gone. When they're 50 to 55 years old, then they're broke. Then there's no pension fund. Oh, and back to this problem of the national deficit. Sorry, we don't even have money for Social Security anymore, guys. These are the problems that are happening. But the problems that are happening that will wipe out people, again, not trying to be too depressing, but shocker, the big opportunities are taking advantage of the people that are too lazy to learn, too lazy to take risk, too scared, too comfortable, too believing in the fact that they're going to be okay, the government's going to take care of them. I'm here to tell you they're not. So for those of you who want to take care of yourself, the opportunities are going to be, investing in the companies that I told you about on the stock market, easy way. But if you don't have jobs, it doesn't really matter. You don't have any money to buy stocks. Building companies that are going to be for sale at very, very low multiples. By the way, a lot of these companies are also over-levered, so you'll be able to take advantage of them now. But the biggest opportunity in 2026 and beyond is investing in your mind, learning how this all works, becoming financially literate, understanding if you're going to get hired from an organization tomorrow or the next year, they're going to expect you to come in and be able to increase the bottom line. Understanding there's going to be more opportunity than ever to build huge dollar businesses with a handful of people. You know what they're betting on in Silicon Valley right now? They are betting all the wealthy one percenters that are flying around their private jet and laughing about what's going to be happening. They're betting which one of them or the people they're investing in are going to build the first $1 billion one-person business. And guess what? It's going to happen. And what does that mean? It's going to hurt a lot of people, but it's going to help a very select few. And at the end of the day, I think what is happening in this economy, what will happen in 2026 that you need to be prepared for, and I believe beyond. Look, I wrote a book called Close Your Wealth Gap. And the idea being is, in this country, it's been happening for a long period of time. The wealthier are getting wealthier, the poorer are getting poorer, and that middle class is being cut out. That will continue to happen. Look at countries like India. You've got towers of, mansions with Rolls Royces pulling out of the gates. You've got people that are squirting the windows of the Rolls Royce, trying to wash the windows, that they're almost getting run over. They live 5 feet away where they don't even have running water, and there's sewage backing up all over the place. Not saying that's exactly what's going to happen, but we are on that path here. If nothing changes, that you're going to see the wealthier get wealthier, the poorer get poorer, and we are not going to have a middle class. And a lot of this just has gone back to all the things that we have done for a long period of time. The weakening of America, the weakening of man, the woke agenda. Everybody gets don't insult everybody. Everybody gets a trophy. Everybody wins. But guess what? In the real world, they're losers. And losers do not prosper. The winners are who prosper. And winning, as my friend Tim Grover would say, is everything. So the question is, going into 2026, are you going to lose? Are you going to win? What work are you willing to put in? What information, what knowledge, what risk are you going to take? Are you going to be on the winning end? Are you going to be in the unemployment line? These are real questions. These are real threats. These are real opportunities that are coming into 2026. And I'm sorry this wasn't one of those. Here's the top 10 stocks to buy. I think I did one of those even last year. But this is just an indication, and I'm an optimistic person, of how different I think the economy is going to be in 2026 and beyond. But the major thing you have to be aware of is the speed of which it's going to happen is faster than I could even articulate. So thanks for watching the American Capitalist Show. And, I'm a big believer in this country. I'm not a believer in what we've been doing the last 20 years to weaken it. I'm not a believer in the 50-year mortgage. I'm not a believer in kicking the can down the road. I'm a believer in stepping up, taking responsibility for yourself, because no one's coming to save you. You're responsible for your own health care. You're responsible for your own safety. You're responsible for your own financial future. And what I try to do on this show is just do my part to help educate you, not scare you, not make you scared into buying something. I'm trying to educate you with the knowledge and information that you need to be a critical thinker, because that's one of the major things we lost in this country is critical thinking. Whether you're on the left or the right, we want to be told what to think, not how to think. And the greatest knowledge, lesson, value that I've got from education is understanding that what education does for you, it teaches you to question things. It teaches you to look beyond the 30-second sound bites. And that's what this show is really about. And so while 2026, I believe there's a lot of fears out there, I also firmly believe, maybe this didn't come across, that is the biggest opportunity that we have seen in our lifetime for people willing to put in the work. So thank you for watching the American Capitalist Show. Please share this episode with somebody who can benefit, someone who's asleep at the wheel, somebody who's looking to better their life. Thank you.